The topic for today is the effects of the bank rate policy. What is actually the bank rate and all? We have already uploaded videos regarding the same. Kindly watch them. Today we shall just discuss the effects of the bank rate policy. See, a change in bank rate may trigger a ripple effect as it impacts every sphere of country's economy. So this is the base, the bank rate. If it changes, it is going to have multiple effects elsewhere, and it will also touch every sphere of your country's economy. So there the changes are so many. Once the bank rate changes, there are so many other simultaneous effects on other things, and let's see one by one what they are. See, a rise in bank rate makes credit costlier. Obviously, if the commercial banks have to pay a higher rate of interest to the central bank, they will be lending it to normal citizens also at a higher rate, because their cost input is expensive. So what they will lend also, it will be on an expensive rate. So the credit becomes costlier to common people, to me and to you, once the bank rate rises. Now, when the credit becomes costlier, it reduces the volume of credit. People will not be so much encouraged to get more and more loans, to borrow so much funds from the commercial banks, because the rate has increased. This will reduce the volume of credit with the people, and obviously it will discourage the economic activity of the entire country. Few people will be borrowing lesser loans because the rate has gone high, so less people will be having less money in their hands. Less number of people only will be taking loans, right? So the economic activity will be slowed down due to rise in the bank rate. And vice versa, if the bank rate falls, the credit becomes cheaper. We all know commercial banks will be getting the loans from central bank at a lower rate, and they will be offering to common people also at the lower rate, right? So the credit for common citizens, me and you, it will become cheaper. Which will increase the volume of credit, means more people will borrow larger amount of funds from the commercial banks. Both ways, the number of people will also increase and the number of funds also will increase. So it increases the volume of credit in the hands of people, which will in turn encourage the businessmen to borrow more and invest more. Obviously, when the loan will be available at a cheaper price, more people will come into business and they will be encouraged to borrow. And obviously, if you are taking the loans, you will be investing it somewhere. So more investment will take place in the country, and which will increase the level of economic activity, but natural, and it will decrease the price level. So this we just discussed in brief what happens when the bank rate falls. Now we are going to discuss the effects of this bank rate policy. How will it affect the country? See the effect on cost and availability of credit. By changing the bank rate, the central bank affects the cost of credit. If bank rate falls or rises, the cost of credit will affect accordingly. By raising the bank rate, the central bank raises the cost of credit. It is as simple as it sounds to be. When the bank rate arrow up goes high, the cost of credit for the whole nation also goes high. By lowering the bank rate, the central bank lowers the cost of credit. If the bank rate falls, the cost of credit will be falling, right? And now comes to the availability of credit. See, by changing the eligibility rules or the conditions under which the commercial banks can secure the loans, central bank influences the availability of credit. Now the rules, the eligibility conditions for how the commercial banks can borrow the loans, right? Central bank will influence the availability of credit in the country. If these eligibility rules are strict eligibility rules make it difficult for commercial banks to get loans from the central bank. When commercial banks will be getting less loans, less funds from the central bank, so obviously less funds will be passed on to the public. So strict eligibility rules, if central bank makes, commercial banks will make it very difficult to get loans itself from the central bank, and so it will not be able to pass more funds to the general public. And lenient eligibility rules make it easy for commercial banks to get loans from central bank. If these rules are lenient, commercial banks will be very easily to get more loans from central bank, which will it easily pass it to the general public. So these eligibility rules or conditions that the central bank will change, and it will. affect the availability of credit to the general public. See, the cost of credit, that is the price dimension of the bank rate policy. Bank rate policies, if we look at it from the price point of view, what we get is the cost of credit. है ना? Cost of credit determines the quantity of borrowing demanded from central bank. If the rate is high, the quantity borrowed will be less. Okay. And the availability of credit, the quantity demanded of the bank rate policy determines the quantity supplied by the central bank. Cost of credit will decide how much money will central bank be able to lend to the commercial bank. Second point is the availability of credit. How are you getting the credit available to the commercial banks? That thing will determine the quantity supplied by the central bank. Right? Borrowing demanded, one thing, quantity supplied, one thing. And when the quantity demanded is equal to the quantity supplied, quantity demanded by the commercial banks from the central bank and the quantity supplied by the central bank to the commercial banks, when these two things become equal, a zero change in the bank rate policy will be appropriate. This means when the quantity demanded of the loan becomes equal to the quantity supplied of the loan, then you don't need to make any change in the bank rate policy. Then there is zero change is required. Then you be there where you are when this condition gets met. Okay. Next point is no simultaneous determination of interest rate and money supply. See, the central bank cannot simultaneously set both interest rate and money supply. Central bank has the power to change interest rate. Central bank also has the power to change money supply, but central bank can do either of this. Ya to it can set this or it can set this. It cannot set them both at one moment of time. See, central bank influences both interest rate and money supply. It can influence both. It can manipulate both these two variants. Changes in bank rate influences the interest rate in the market. Very simple. If the bank rate will change, the other interest rates prevalent in the money market, they will change automatically. This goes higher, this goes higher, right? Now, changes in amount that central bank is willing to lend, the influences the money supply. Now, how much is the central bank willing to lend the money, right? That will affect the money supply. Now, how much is central bank willing? If it is willing to lend higher amount, money supply will be higher in the market. People will have more money in their hands. If central bank is not willing to lend more cash, so people will not have more cash in their hands. Further, see, we see it from this curve. This figure very well illustrates that central bank can either influence one out of these two determinants. See, this DD is the community demand curve, MM is the supply of money curve, this MM, and OI is the rate of interest. This OI is the rate of interest. And when this quantity of money and this demand curve meet, so this is the decided the rate of interest, OI is the final. So given the demand for money curve DD, if the central bank wants the rate of interest to rise from OI to OI1, then the central bank must reduce the supply of money from OM to OM1. So now please listen carefully. This is your money supply curve and this is the commodity demand curve. They meet here and this is the finalized rate of interest. If central bank, which has the power to influence the rate of interest, if it wants that interest should rise from OI to OI1, then the central bank has to reduce the supply of money from OM to OM1. If it wants that this has to rise here, so central bank has to reduce this from here to here. Okay. If the central bank wants the rate of interest to fall from O1 to O1, if OI to OI2, sorry, if the central bank wants that this prevailing rate of interest, which is OI, it has to fall to OI2 here, then in that case, it has to increase money supply from OM to OM2. I repeat, if central bank wants the rate of interest to fall to OI2, it has to increase the money supply to M2. Right. So if it wants this to go higher, this it has to reduce. If it wants this to go lower, it has to increase this. This is what this figure is trying to tell you. Now, in the same figure, if the central banks wants to reduce the money supply from OM to OM1, if it wants that this money supply is OM, it should reach to OM1, then what has central bank to do? It has to increase the rate of interest to OI to OI1. If it wants that this curve should come here, this point should come here, then it has to raise this rate of interest. And if the central bank wants to increase the money supply from OM to OM2, if it wants that this money supply it should come till here in the market till OM2, then it must reduce the rate of interest from OI to OI2, right? So in the previous slide, I told you if it wants to vary the rate of interest, then you have to change the money supply. And in this slide, I'm telling you that if it wants to reduce the money supply, then it has to change the rate of interest. Hence, given the demand for money function, hence given this line, this curve, the central bank cannot simultaneously choose an interest rate and money supply. You can choose, central bank has the power. See, I repeat, central bank has the power to influence interest rate. It has the power to influence the money supply, but it does not have the power to simultaneously decide both these things. If it is keen on maintaining a particular interest rate, then it has to change the money supply. And if it is keen on restricting itself to this particular level of money supply, then it has to change the interest rate. So no doubt it can influence both these variants, but it cannot simultaneously choose interest rate and money supply at one moment of time. It can choose only one. Okay. Next slide. Effect on the level of economic activity. See, a change in the bank rate leads to the corresponding changes in other rates in the market. As I told you before, if bank rate changes, other rates in the market also gets influenced. The credit will become either dearer or cheaper. Obviously, bank rates say either the credit will become costly or it will become cheap. The willingness of the businessman to borrow and invest will also undergo a change. If the rates are high, businessmen will not borrow, businessmen will not invest. If the rates are low, the credit is available at a cheaper cost, the businessmen will borrow more, invest more. This will affect the level of economic activity either this way or that, and that will also affect the price level. Okay. Next point is the announcement effect. The announcement of a change in the bank rate influences the credit psychology in the country. People's psychology undergo a change when the bank rate changes. See how important it is. A rise in the bank rate is regarded as official signal for the beginning of the period of a relatively dearer money. Everything is going to get costly. The money is going to get costly if the bank rate is increased. So this is how the psychology is going to work of the people. And if there is a fall in the bank rate announcement, there's an indication for the onset of a cheaper money phase. Credit will be available at a very low cost. This goes for the psychology of the people. This is how the announcement of bank rate change affects the country. Next point, bank rate policy during inflation and depression. See, bank rate policies used to control inflation and deflation in the country. During inflation, the central bank increases the bank rate. When the inflation is prevalent in your country, the central bank will automatically raise the bank rate. As a result, other interest rates in the money market will also rise. This is what I am repeating in the previous slides. If the bank rate rises, the money market, other interest will also rise. This raises the cost of bank credit. The credit will be available at a expensive rate. This will discourage the businessmen from borrowing from banks. So, the volume of money in the country will decrease. The level of economic activity will decline because businessmen will be discouraged to invest. Level of economic activity will fall and the price will fall. So, we combat inflation, right? But during depression, it's the other way around. The bank rate is reduced by the central bank. It will reduce the market rate of interest. Obviously, this makes the bank credit cheaper. Now you will get loans at a cheaper rate, right? It encourages the businessmen to borrow and invest. So if the credit is available at a cheaper rate, more people will borrow more funds. They will invest more. This pushes up the level of economic activity, which was lying a little low in deflation, and hence pushes up the price level. And the motive deflation is combated. This is how bank rate policy happens and affects during inflation and depression. Next is the effect on the balance of payment. See, a rise in the bank rate will set right an adverse balance of payment. If the balance of payments are gone in the wrong direction, when you rise the bank rate, it will set right, it will set in your favor. How does this happen? An adverse balance results in outflow of gold. Gold goes out of your country when the balance of payment is not favorable. If the bank rate is raised, other interest rates in the money market go up, right? As a result, there will be movement of foreign capital into the country. People will be willing to invest in your country. Foreign capital will come into your country because other rates are high, because of better returns and stoppage of capital going out of the country. The capital won't go out of the country. Why will people, native citizens, why will they invest outside when they will get higher rate of interest in your own country, right? Foreign capital will come into your country and your capital will not go out of your country. The demand for domestic currency will rise. Okay, raising its value, the value of your currency will go high and making the exchange rates more favorable. So the balance of payment is set right when the rise in the bank rate takes place. So here we come to the end of the article. I hope you understood the concept very nicely. Please comment in the comment section if you want to share something. Thanks for watching. Stay safe, stay blessed. Please like and subscribe to my channel. Thank you.